Ever wondered how a tax code can disrupt an entire industry? Let's delve into the curious case of Tax Code 280E. This seemingly innocuous piece of legislation buried deep within our tax laws holds a profound influence over the burgeoning cannabis industry. Its roots are firmly planted in the soil of the United States war on drugs, yet its reach extends far beyond, casting a long shadow over businesses that operate within the legal boundaries of their states. The implications are far-reaching, the stakes high. This tax code, a mere 4 lines of text, has the power to shape the future of an industry worth billions. As we delve deeper, we'll explore its origin, its impact, and the ongoing debate around its future. So buckle up for a journey into the labyrinth of tax laws, where nothing is as simple as it seems. Stay tuned as we unravel the enigma of Tax Code 280E. The creation of Tax Code 280E has an intriguing history, rooted in the late 20th century. To truly understand its origins, we need to turn back the clock to 1982. It was in this year that the American tax landscape forever changed, all thanks to a peculiar court case involving a rather unorthodox businessman. This businessman was, in fact, a drug dealer. The dealer, known as Jeffrey Edmondson, was audacious enough to list his illegal activities as a business on his tax returns, and he even went as far as deducting his business expenses. These expenses range from the cost of travel and phone calls to buying scales for weighing his product. This act stirred quite a controversy. The Internal Revenue Service, or the IRS as we commonly know it, was in a quandary. On one hand, there was no explicit regulation that prevented such deductions. On the other hand, allowing a drug dealer to benefit from tax breaks seemed absurd, if not outright wrong. The case eventually found its way into a courtroom, and the judge ruled in favor of Edmondson. The court stated that while his activities were illegal, there were no specific tax laws that prohibited him from claiming these deductions. This ruling sent shockwaves through the legislative halls of America, prompting immediate action. In response, Congress swiftly passed Tax Code 280E later that same year. The code explicitly states that no deductions or credits shall be allowed for amounts paid or incurred in the carrying on of any trade or business, if such trade or business consists of trafficking in controlled substances. The objective was clear: to prevent individuals involved in illegal activities from profiting off the tax system. By doing so, the government hoped to discourage these activities and maintain the integrity of the tax code. Thus, the tax code was born out of a need to prevent illegal activities from profiting off the tax system. The Tax Code 280E, though targeted at illegal drug trade, has had a profound impact on the legal cannabis industry. This law, originally designed to penalize illicit drug trafficking, has become an unanticipated burden on a flourishing industry. The legal cannabis business, which has seen a surge in recent years, is significantly affected by this tax code. The primary challenge lies in the fact that these businesses cannot deduct their everyday operating expenses. Let's delve into this. Imagine running a business where you can't write off common costs like rent, utilities, or even employee salaries. That's the reality for legal cannabis businesses under Tax Code 280E. Because cannabis is still considered a Schedule I substance under federal law, businesses in this sector are denied the usual tax deductions and credits that other industries enjoy. This impact is far-reaching. It affects not only the business owners but also the employees and consumers. For instance, when businesses can't deduct their expenses, they may need to cut costs elsewhere. This could mean lower wages for employees or higher prices for consumers. Moreover, the financial strain caused by this tax code can stifle growth and innovation in the industry. Businesses may be reluctant to expand or invest in new technologies because of the high tax burden. This can lead to a stagnation in an industry that has the potential to offer a wide range of benefits, from medical advancements to economic growth. The irony of this situation is hard to miss. A law designed to deter illegal drug trade is now hindering the development of a legitimate and legal industry. It's a classic example of unintended consequences, where a solution to one problem creates a new problem in its wake. Yet, despite the challenges, the cannabis industry continues to persevere. Businesses are finding creative ways to navigate the tax landscape while advocating for change in the legislation. Ironically, a law meant to deter illegal activities has become a thorn in the side of legitimate businesses. This statement is a stark reminder of the need for policy to keep pace with societal changes and industry evolution. The Tax Code 280E has sparked a fiery debate in recent years. The relevancy of Tax Code 280E in the modern context, its implications, and the call for reforms have ignited a lively discourse among tax professionals, policymakers, and industry players. While some argue that this tax code serves as a necessary check on industries traditionally deemed illegal, others contend that it unfairly penalizes businesses operating within the law. At the heart of the debate, you'll find a clash of perspectives. On one side, there's the view that Tax Code 280E is a relic from the past, a remnant of the war on drugs that no longer fits the socio-economic landscape. This camp argues that the code is a burden on legal businesses in industries such as cannabis, hindering their growth and stifling innovation. They believe it's high time to reform the tax code and make it more conducive to the realities of today's market. On the other side of the spectrum, there are those who uphold the necessity of Tax Code 280E. They argue that its stringent regulations serve as a deterrent against illicit activities and help maintain a level playing field. For them, the tax code is not a punitive measure but a protective one, ensuring that businesses cannot exploit legal loopholes for illegal gains. However, the debate doesn't stop there. There's also a growing call for a more nuanced approach to Tax Code 280E. This perspective suggests that while the code may need reforms to adapt to changing realities, it shouldn't be discarded altogether. Instead, it should be refined, reshaped, and redefined to accommodate the evolving business environment while still maintaining its purpose. So here we are, amidst a vibrant and ongoing debate where the past and the present are in a tug of war, and the future of Tax Code 280E hangs in the balance. As the discussions continue, the stakes get higher, and the need for a resolution becomes more pressing. The question remains, will the tax code evolve with the changing times? The future of Tax Code 280E hangs in the balance as advocates and detractors lock horns over its fate. This tax code, for so long the bane of the cannabis industry, may be on the brink of change, and the implications of such a shift could be far-reaching. Let's start by examining the potential changes on the horizon. One of the most significant modifications being proposed is to exclude cannabis businesses that operate in accordance with state law from the purview of this tax code. This would essentially allow such businesses to deduct their operational costs, just like any other business. The impact of this change could be a game changer for the cannabis industry, potentially ushering in a new era of growth and prosperity. There are also calls for more comprehensive reforms. Some argue that the tax code needs to be updated to reflect the changing societal attitudes towards cannabis. They propose a complete overhaul of the tax code, including a revision of the definition of trafficking and a reassessment of how costs are allocated. Such reforms could go a long way in leveling the playing field for cannabis businesses, allowing them to compete on equal footing with other industries. But the possibility of abolishing Tax Code 280E altogether also looms large. If this were to happen, it would represent a seismic shift in the taxation of the cannabis industry. However, this is a contentious issue that has divided opinion. Detractors argue that abolition could lead to a loss of tax revenue, while advocates maintain that it would stimulate economic growth and job creation. The implications of these potential changes are vast. They could fundamentally alter the landscape of the cannabis industry, opening up new opportunities and posing new challenges. But they also raise important questions about fairness, economic policy, and societal values. As the debate rages on, the future of Tax Code 280E remains a captivating topic of interest. Whether it will be reformed, abolished, or remain unchanged is uncertain. But one thing is for sure, the outcome will have a profound impact on the cannabis industry and beyond. From its inception to the ongoing debates, Tax Code 280E is more than just a tax law. It's a compelling testament to the tangle of legal, business, and social considerations that shape our tax system. Born out of a unique historical context, this tax law has left a significant imprint on businesses, particularly those in the cannabis industry, and stirred a whirlwind of controversy. Its impact has been profound, affecting the financial viability of many businesses and sparking intense debates about fairness and equity in taxation. Controversies surrounding Tax Code 280E have brought forth questions about the role of tax law in shaping industry practices and societal norms. The future of this tax law remains uncertain, as it continues to be a hot topic of discussion among lawmakers, business leaders, and tax professionals. But one thing is clear: the journey of Tax Code 280E serves as a testament to the complex interplay between law, business, and societal norms.